Hey everyone, welcome back to Finance Plus Investment. One of the most common questions I get is, what are the best long-term investments right now? Building long-term wealth isn't about chasing quick returns. It's about making smart, strategic decisions that will pay off for you years, even decades down the line. That's what we're going to be diving into today. Now keep in mind, I'm not a financial advisor, this isn't financial advice, and this is just for informational purposes only. Let's kick things off with growth stocks. When I say growth stocks, I'm talking about companies that are expanding rapidly and have the potential to dominate their markets. Think tech giants like Alphabet, the parent company of Google, or Amazon, the e-commerce behemoth. These companies are constantly innovating, pushing boundaries, and finding new ways to grow their revenue and profits year after year. But here's the thing about growth stocks, they're not for the faint of heart. They can be volatile, meaning their prices can swing up and down pretty dramatically in the short term. But if you're patient and you believe in the long-term potential of these companies, growth stocks can be an absolute goldmine for your portfolio. Just remember, diversification is key. Don't put all your eggs in one basket, even if that basket is Amazon. Spread your investments across different sectors and industries to minimize your risk. Do your research, look at their financials, understand their business model, and make sure you're comfortable with the level of risk involved. Investing in growth stocks is like hitching your wagon to a rocket ship. It might be a bumpy ride, but if you hang on tight, you could be in for some astronomical returns. Now, if you're not quite ready to pick individual stocks, don't worry. There's a fantastic alternative: stock funds. Stock funds, also known as mutual funds or ETFs, pool your money with other investors to buy a diversified basket of stocks. This means you're not betting on the success of just one company, but on the performance of an entire market sector, industry, or even the entire stock market itself. They offer built-in diversification, which can help to reduce your risk. Plus, they're managed by professional portfolio managers who do all the research and stock picking for you. But it's important to remember that not all stock funds are created equal. Some funds charge higher fees than others, and some funds have different investment objectives. So it's crucial to do your research, compare different funds, and choose the ones that align with your investment goals and risk tolerance. Alright, let's switch gears and talk about bonds. Specifically bond funds. Bond funds are like the steady eddies of the investment world. They're not going to make you rich quick, but they offer something just as valuable: stability. You see, bonds are essentially loans that you make to governments or corporations. When you invest in a bond, you're lending your money to the issuer, and in return they promise to pay you back with interest over a set period of time. Bond funds work by pooling your money with other investors to buy a diversified portfolio of bonds. This diversification helps to reduce the risk that you'll lose money if one particular bond issuer defaults on their debt. Bond funds typically generate lower returns than stock funds, but they're also less volatile, making them a great addition to any diversified portfolio. Next up, let's talk about dividend stocks. These are stocks that pay you to own them. With dividend stocks, you get the best of both worlds: the potential for stock price appreciation and a regular stream of passive income. Dividends are payments made by companies to their shareholders, typically on a quarterly basis. These payments are usually a portion of the company's profits and can provide you with a nice little income boost, especially if you reinvest those dividends back into buying more shares. Now, not all companies pay dividends, but there are some companies known as dividend aristocrats that have a long history of increasing their dividends year after year. Investing in dividend stocks can be a great way to generate passive income and build long-term wealth. However, it's important to remember that dividends are not guaranteed, and companies can cut or eliminate their dividends at any time. Now let's talk about value stocks. These are like those hidden gems you find at a flea market. They might not be flashy or glamorous, but they're often undervalued and have the potential to be worth a lot more than you paid for them. Value stocks are typically companies that are trading at a lower price relative to their fundamentals, such as earnings, sales, or book value. This could be due to a number of reasons, such as a temporary setback, negative news coverage, or simply being overlooked by the market. The key to value investing is to identify these undervalued companies, buy their stock when the price is low, and then hold on patiently until the market recognizes their true worth. Value investing requires a bit more research and analysis than other investment strategies, but it can be incredibly rewarding if you're successful. Now, if you're looking for a truly hands-off investment approach, target date funds might be right up your alley. These funds are like the set it and forget it option of the investment world. Target date funds are designed for investors who are saving for retirement. You simply choose a fund with a target date that aligns with your expected retirement year, and the fund managers do the rest. The magic of target date funds is that they automatically adjust their asset allocation over time to become more conservative as you get closer to retirement. This means that when you're young and have a long time horizon, the fund will be more heavily invested in growth-oriented assets like stocks. But as you get closer to retirement, the fund will gradually shift its holdings to more conservative investments like bonds. Target date funds are a great option for investors who want to take a hands-off approach to retirement saving and don't want to have to worry about rebalancing their portfolio on their own. Let's move on to something a little more tangible: real estate. Real estate has long been considered a solid long-term investment, and for good reason. It's a physical asset that people will always need. After all, we all need a roof over our heads. Investing in real estate can provide you with a number of benefits, including rental income, property appreciation, and tax advantages. Plus, it can be a great hedge against inflation, as property values tend to rise along with the cost of living. Now, real estate investing isn't for the faint of heart. It requires significant capital, it can be illiquid, and it often involves being a landlord, which comes with its own set of challenges. But, if you're willing to put in the work, real estate can be a fantastic way to build long-term wealth and generate passive income. And hey, if you're not ready to become a landlord quite yet, there are other ways to invest in real estate, such as through REITs or real estate investment trusts. Now let's talk about small-cap stocks. Small-cap stocks are shares of companies with relatively small market capitalizations, typically under $2 billion. These companies are often in their early stages of growth and have the potential to become the next big thing. Investing in small-cap stocks can be incredibly rewarding, as these companies often have the potential to generate outsized returns. However, it's important to remember that small-cap stocks are also inherently riskier than large-cap stocks. They tend to be more volatile, their financials might not be as solid, and they might not have a proven track record of success. But if you're willing to stomach the volatility and do your research, small-cap stocks can be a fantastic addition to a diversified portfolio. Let's face it, not everyone has the time, energy, or desire to manage their own investments. And that's where robo-advisors come in. Robo-advisors are automated investment platforms that use algorithms to build and manage your investment portfolio for you. All you have to do is answer a few questions about your investment goals, risk tolerance, and time horizon, and the robo-advisor will take care of the rest. Robo-advisors typically invest your money in a diversified portfolio of low-cost ETFs, and they automatically rebalance your portfolio as needed to keep it aligned with your investment goals. They're a great option for investors who are just starting out, who don't have a lot of money to invest, or who simply prefer a hands-off approach. Last but not least, let's talk about Roth IRAs. A Roth IRA is a retirement account that offers some incredible tax advantages. With a Roth IRA, you contribute after-tax dollars, meaning you pay taxes on your contributions up front. But here's the kicker: your money grows tax-free, and you don't have to pay any taxes on your withdrawals in retirement. This can save you a ton of money in taxes over the long run, especially if you anticipate being in a higher tax bracket in retirement. Plus, Roth IRAs offer a lot of flexibility. You can withdraw your contributions at any time without penalty, and you can choose to invest your money in a wide range of assets, including stocks, bonds, and mutual funds. If you're eligible to contribute to a Roth IRA, I highly recommend it. So, there you have it, my top 10 long-term investments for 2025 and beyond. Remember, building long-term wealth is a marathon, not a sprint. It's about making smart strategic decisions that will pay off for you years down the road. Whether you're just starting out or you're a seasoned investor, there's an investment strategy out there that can help you achieve your financial goals. So don't wait. Start investing today, even if it's just a small amount. And hey, if you found this video helpful, be sure to give it a thumbs up, subscribe to the channel for more finance and investment tips, and let me know in the comments below which of these investments you're most excited about. Thanks for watching.